Hi, I'm Steve Richardson, and this is the March 2019 episode of Lunch with a Lawyer. Today we're going to talk about what are called health savings accounts. And these are great vehicles for young people. With the Affordable Care Act, it's been around for a while under President Obama, also referred to as ObamaCare, as its more recognizable name. And it requires people to have health insurance. And one of the ideas behind this was to sort of balance things out a little bit. And if you have young people who are usually in very good health, don't need to use a doctor a lot, and they're paying in premiums, and the insurance companies aren't paying out in services all that often, then that might balance out a lot of the higher demand for healthcare services as you get older, and overall make health insurance more affordable for people. Well, that's a great idea, but the problem is that if you're in your 20s, a millennial, and you're graduated college and you have a lot of student loans, it's not unusual to have between $30,000 or $40,000 in student loan debt that you have to start paying back once you're out in the workforce, or basically once you've graduated, you got to start paying it back whether you're employed or not. So you have that, you have rent, you have car payment, other living expenses that you got to pay, and on top of all of that, you got to pay a health insurance premium. Well, here's a solution that I think young people should look into. If you find yourself in that situation where you got to get the insurance and it's really eating into your pay, what do you do? Well, one way to do that, obviously the higher the deductible you have on a health insurance policy, the lower the premium is going to be, because you'll be expected to pay more before the insurance company has to start kicking in money. Now that's co-pays or something else for services, and they come in, but basically deductibles where you pay for the services as billed until you meet your deductible, and then the insurance company starts paying. And there may be co-pays involved in that, but as you see. So obviously, the higher your deductible, the lower your premium should be. So there's something that was created in 2011 called a health savings account. And what that is a tax-exempt trust or a custodial account that's established by an individual or a family to pay for medical expenses. It's a savings account. Okay, so you get it only if you have a high deductible health plan, an HDHP. So it's designed, health savings accounts are designed for people that can't afford these premiums and have to set aside the money. So the idea is you're a young person, you don't anticipate, unless you get in, you're hurt or you experience an unexpected illness. But if you're in relatively good health, you're paying for something you're not using much of, okay? But if you're putting money aside into this health savings account, it's a savings account like anything else. And you'll see as I get further into the details of how health savings accounts work, these funds can really benefit you in the long term. So, how to be eligible? Well, you have to be covered, as I said, and this is from the IRS website, under a high deductible health plan. Now, what is that? Well, in 2019, this year, and of course, numbers, are going to change from year to year, depending on when you see this video as a recording later. You have to check with the IRS to see what the numbers are. But this year in 2019, your plan deductible must be at least $1,350 for an individual, or $2,700 for family coverage. Okay, now that's a fairly large deductible. And a maximum annual deductible of $6,750 for individual and $13,500 for family coverage. So there you have a range, a minimum of a maximum. Individuals $1,350 to $6,750, and families $2,700 to $13,500. Now you can still be eligible as an individual even if your spouse has a non-high deductible health plan, provided you aren't covered by that plan. You can also have additional insurance that provides benefits for certain items such as liabilities incurred under workers' compensation laws, property insurance, things like that, insurance for a specific disease or illness, or a fixed amount per day or other period of hospitalization. You also can't be enrolled in Medicare. Now, I know I'm talking to the audience really here for this is young people, but once you establish one, you're going to have one hopefully for a while, and it gets to a point where you get too old for it. Well, I'll get into that in a minute, but basically you can't be enrolled in Medicare, and you can't be claimed as a dependent on somebody else's tax return. All right, so you got to be out on your own. Now, you can also have other coverage, whether it's provided through insurance or otherwise, for things like accidents, disability, dental care, vision care, or long-term care. So you can have those policies as well and not end up disqualifying yourself for a health savings account. Now, how do you set one up? Well, you don't have to get any permission from the IRS to do it. Okay. If you're employed, check with your employer to see if they have a health savings account plan. Many times I've seen, as a bankruptcy attorney, going through pay stubs, and I'll see deductions and contributions to a health savings account. So your employer might have one. We'll check with them, but you can also set it up yourself. It can be established through a trustee that is different from your health plan provider, but you can set one up and talk to maybe someone in HR with your company. Even if they don't offer it, they may be able to give you some information, and I'll try to leave some links to the IRS website on that. Now, how much can you contribute to the plan in the course of a year? Well, that depends upon the type of HP, high deductible health plan coverage you have, your age, the date you become an eligible individual, and the date you cease to be an eligible individual. Basically, for 2019, if you have a self-only coverage, you can contribute up to $3,500, and if you have family coverage, you can contribute up to $7,000. Okay, so look at it also from the point of view of what your deductible is. So the minimum deductible to have a high deductible plan is $1,350 for an individual, and you can contribute $3,500 to that. So more than twice of what your deductible is, you can put into this plan. And of course, $7,000 for family, as opposed to the minimum $2,700. So you're really almost triple for that. So you can put a fair amount of money into it per year. Just like there are caps for contribution to an IRA, traditional or Roth, there are caps to a health savings account, but that's what they are. Now, how can I use the money? Well, you got to be careful, all right? There's some pros and cons to this. The money's sitting in the account. And what can you use it for? Well, you can receive tax-free distributions from your health savings account to pay or be reimbursed for qualified medical expenses you incur after you establish the account. If you receive distributions for other reasons, okay, so if you take money out of the account and it's not for qualified health insurance, you're going to pay subject to income tax, and also may be subject to an additional 20% penalty. So there can be penalties to taking it out if it's not for paying for health for treatment, medical treatment. Now, you don't have to make withdrawals from your account. You may not need it here. You can put the money in, you don't need it, it continues to sit there. Okay, so you put it in, it still inures to your benefit even if you don't have to take it out. So, now, what are qualified medical expenses? Well, the IRS identifies those as the cost of diagnosis, cure, mitigation, treatment, or prevention of disease, and for the purpose of affecting any part or function of the body. These expenses include payment for legal medical services rendered by physicians, surgeons, dentists, and other medical practitioners. They include the cost of equipment, supplies, and diagnostic devices needed for these purposes. Medical care expenses must be primarily to alleviate or prevent a physical or mental disability or illness. They don't include expenses that are merely beneficial to general health, such as vitamins or a vacation. So if your health is better in the arid weather of Arizona and you want a winter in Arizona, well, your health savings account's not going to pay for that. So you got to have they have to be qualified expenses. Now, medical expenses can also include premiums you pay for insurance that covers the expense of medical care and the amounts you pay for transportation to get medical care. So if there is a hospital or a surgeon or somebody that renders a type of treatment that you can't get in your area and you have to travel a distance to get it, well, that can be covered. They also include amounts paid for qualified long-term care services and limited amounts paid for any other qualified long-term care insurance contract. Now, again, I'm talking to young people, but this money, as I said, if you don't spend it, it continues to sit in the account. It can grow and grow and grow. All right. They can grow. It grows tax deferred. Okay, for later use. And as I said, if you use the funds for non-medical purposes, you have the taxes, and that happens if you take it out prior to being 65. Now, here's some better good parts, and the other advantage of having a health savings account as a young person. There are a lot of tax advantages. Okay, one website described a health savings account as an IRA on steroids. Okay, there's a triple tax advantage. The contributions are tax deductible. Okay, so it's pre-tax money. Tax-free accumulation of interest and dividends. All right, so the money is tax-free going in, tax-free growing, and tax-free distributions for qualified medical expenses. So you put it into the account. You may not use it this year. You may not use it for 2 or 3 years, but it's growing, and you're contributing to it. And you have more and more money, so if you really need it, it's there to take out, and you don't get taxed on that growth when you take it out for qualified medical purposes. You can claim a tax deduction for contributions you or someone other than your employer makes to your health savings account, even if you don't itemize your deductions. So that's great under our new tax laws, where people are more, you can get a greater deduction without itemizing, but even so, you can, even if you have expenses that can be deductible way above the standard deduction, you don't have to itemize to get it. Contributions to your account made by your employer may be excluded from your gross income. Again, pre-tax money used to fund it. Contributions remain, as I said, until you use them. Interest and assets in the account are tax-free. Distributions, tax-free if you pay qualified expenses. And also, the account's portable. So let's say you set it up and it's set up by your employer. It's one of their benefits of employment, and you leave that employment. You go somewhere else. Well, it's portable, just like a 401k is. Okay, you can move it. So that's good. General exempt from tax. So now, can you contribute to your account after age 65? This is where I was talking about Medicare. All right. Even though the tax ding for taking the money out for non-medical purposes ends at age 65, you can still continue to contribute to it. You can no longer make new contributions to the account after you've signed up for Medicare Part A or Medicare Part B. Okay, so that's good. Now, the tax benefits do not phase out at certain income levels. So that's another part of a health savings account being an IRA on steroids. There are certain, a Roth IRA, there's a maximum income level that you have in order to contribute to a Roth IRA and get those benefits. Otherwise, you'd have to use a traditional IRA. So there's no maximum there. Now, here's the other big thing, okay? Remember, the tax penalty for taking out the money for non-health purposes is before 65. So let's say you continue to contribute to this health savings account while you're working. And by the time you reach age 65, you sign up for Medicare, you can't make new contributions, the tax ding goes away. Well, guess what? You can take it out for any purpose, tax-free, right? Because the tax penalty is only before age 65. So if you're contributing to your employer's 401k, you have an IRA or that sort of thing that you're putting money in, the health savings account becomes an additional fund towards your retirement portfolio. Because if there's any money left after age 65, after the tax penalty goes away, and after you can't contribute to it anymore, once you sign up for Medicare, that's additional money that's grown, okay, over the years. So it's a great investment. So obviously, this is a great thing to look into. If you're a young person that's struggling with trying to pay these premiums, look into a health savings account, because you may be able to raise deductible significantly, lower your premium, be able to put some money aside into that account should you need it against a deductible, all right? And you continue to contribute to it. You're starting young. Everybody should start saving for retirement young, because of compounding rate of returns and interest are really beneficial. So you're starting young, it's building over time. If you continue to contribute to it throughout your working life, you may have to take the money out to pay for medical expenses, and it's there if you need it as part of your overall financial picture. But to the extent that there's money left over when you retire, then that's extra funds. So it's a great thing to look into. So the bottom line here is that if this sounds appealing to you, talk to your HR people, talk to a tax professional, okay? I've researched this on the IRS website. I'm giving you this information, but I'm not an accountant and I'm not a tax attorney, all right? So you're gonna wanna do a deeper dive into this. In a future episode of my podcast, Financial Freedom Podcast, I'm going to look into these in a little bit more detail. There are different types of health savings accounts. There's something called a flexible savings account, an FSA, which I'll talk about a little bit. But this is to get you started on it, really. So look into it further. Talk to your HR people, talk to a tax and investment professional that can give you a detailed opinion on your situation, your tax situation, help you set up the health savings account and get things rolling for you. But a lot of good advantages to that. So that's it for this episode of Lunch with a Lawyer for March of 2019. I hope you enjoyed the content. If you like this video, please click that like button, that thumbs up button on Facebook to like it. It helps to spread the joy and spread the knowledge. The more people like it, the more it shows up in other people's feeds, and the more people get access to this information. If you can also share it. If you just click that share button on Facebook, share it with your friends. Say, hey, look, here's some information. If you're a millennial, you have other people that are struggling with this, or you have children that are millennials, share it with them to spread the knowledge on Facebook. Also, within the next week or so, I'm going to be posting this to my YouTube channel, richardson.lawoffices.tv. So you can also share that link or share it on YouTube. And if you like it on YouTube, click the like button. Again, that'll help spread the joy. And if you have any ideas for a subject for Lunch with a Lawyer, then feel free to leave a comment on Facebook or in the comments for my YouTube video, and let me know what you'd like to hear about. I'd love to hear from you. And finally, if you're looking at this on YouTube and you're enjoying this and you're enjoying the content, I post regular videos to this, and you may want to make sure you don't miss anything. Click that subscribe button, that blue R button, and get subscribed to YouTube and hear about all my new content. So that's it for Lunch with a Lawyer. I'll see you next month.